Welcome back to Financial Fortitude, the show that helps high earners, families, and business owners live well today while planning wisely for tomorrow. I'm Michael Acosta, joined by my co-host, Brady Hemmerle.
Today, we're digging into a topic that gets thrown around in a lot of financial circles: Roth IRAs and Roth 401ks. What are they? How do they differ? When should you fund one versus the other? And what income thresholds should you be mindful of?
Whether you're just starting to save for retirement or already building significant wealth, this conversation is going to help you think strategically about where each Roth vehicle fits into your plan. Welcome to Financial Fortitude, a podcast for high earners, families, and business owners. We're your hosts, Michael Acosta
and Brady Hemmerle. Each week, we bring purpose-driven financial guidance to you so you can be assured you're on the right path. If you're looking to become an extraordinary wealth builder, let's dive in. Michael, I'm excited about this conversation because I feel it's one in any investment planning type meeting that we're always addressing. Should I use my Roth IRA? Should I use my 401k? How are they different in any capacity? Like, is there a real strategy that goes into using one versus the other, or should I just be putting money in one or both?
Yeah, and I would say that those are probably better questions that are asked in consultations with prospects and clients when sometimes we get other questions around, should I even have a Roth IRA, or is it really even worth going through the trouble of funding one when I can just get a tax deduction this year with a traditional or pre-tax IRA or 401k?
And I think it's very prudent to have these conversations because ultimately the 401k is the primary builder of wealth for most W-2 employees. And the IRA is the individual version of that for the small business owner, maybe self-employed person. So it's a conversation that everyone's having, but I think a lot of the strategy, at least that goes into how we think through things as a framework, oftentimes is not always addressed. And our biggest goal for any clients is to have them understand the why behind the decisions that we make.
No, absolutely. We've echoed this on multiple episodes, right? Every decision we make with our dollars today is a trade-off for something different or something else in the future. And there needs to be an order of operation. We need to be purpose-driven with where we're allocating our army of dollar bills and where we're putting our capital on our balance sheet, whether it's for short-term or mid-term or long-term goals. So if I understand correctly, based on what we've talked to up to this point in our podcast episodes, Roth IRAs, Roth 401ks in general fall in line into the category of retirement savings, retirement planning, which in theory should be a longer term bucket, in theory. Not always the case though, especially when influencers on social media or talking heads in the media like to overutilize the benefits of a Roth IRA for dual purpose, right? Oftentimes it comes up, hey, Roth IRA should be used for college planning. Roth IRA should be used as an emergency fund because you can withdraw your principal without penalty, this, that, and the other. For us, correct me if I'm wrong, we like to keep it as simple as possible and not overextending ourselves into other areas from a planning perspective or from an asset type perspective to say, hey, this is a long-term bucket. Let's really earmark it for that. Let's not utilize it in any other way that we don't have to so that we don't overcomplicate the situation.
Sure. So for our listeners who are either newer or perhaps asking some of these questions themselves, if you were to define in very simple terms what a Roth IRA is and why someone might use it, what does that look like, at least in your words?
Yeah. So I'll give you two responses. I'm going to give you in my words, and then of course I'm going to go to Investopedia as a resource to give a more what I would call quote unquote Wikipedia type of responsive definition. But a Roth IRA is really just a retirement account that gives you the opportunity to make after-tax contributions, whether, from your earnings. And once it hits that account, it's invested. Any growth that you experience over that account between now and to the time that you pass away can be distributed or withdrawn from that account tax exempt if you meet the requirements of taking out distributions or withdrawals after age 59 and a half.
In simpler terms there, the real advantage is what?
So the real advantage is the future tax-exempt growth, meaning if I put $100,000 of after-tax dollars in my Roth IRA and it grows over the course of 15, 20 years to be worth, let's just call $750,000, I truly have $750,000 to spend, again, assuming that I meet the requirements of being over the age of 59 and a half. Versus if I put that same $100,000 into a pre-tax IRA and it grows to be $750,000 in the future, when I take those distributions are going to be subject to ordinary income tax. So I will have some share in that $750,000 with the IRS.
So using the Roth IRA, and where we'll get to here in a moment, the Roth 401ks, you're just paying taxes today to eliminate that partnership that you have with Uncle Sam later, effectively.
Correct. And to give a more formal definition, again, referring to Investopedia, a Roth IRA is a type of tax-advantaged individual retirement account to which you can contribute after-tax dollars towards your retirement. Known as an individual retirement arrangement by the IRS, the primary benefit of a Roth IRA is that your contributions and the earnings on those contributions can grow tax-free and be withdrawn tax-free after age 59 and a half, assuming the account has been open for at least 5 years. In other words, you pay taxes on the money going into your Roth IRA, and then all future withdrawals are tax-free. The feature of a Roth IRA account can vary between providers, and you should compare the best Roth IRA accounts before making a choice. Again, that was directly from Investopedia with the article Roth IRA, what is it and how to open one.
So then explain what a 401k is or a Roth 401k is, because is it different? Is it the same? Both of them have Roth in the words, right?
Yeah. So let's scale it back and just take generalizations. Let's just compare IRAs versus 401ks. Again, IRA stands for individual retirement account. It's going to be for anyone who wants to go and open up their own personal account that's dedicated for their future retirement. Who might need one of these? Well, either people who are planning on maxing out their 401ks and want to save additionally above and beyond that for retirement, or individuals whose employers maybe don't offer a retirement plan, something known as a defined contribution plan, 401k, SEP IRA, simple IRA. In this case, we're focusing on 401ks. A 401k is really just a defined contribution plan that is offered to you by your employer. Now, as you start to compare the two side by side, there are differences by way of how much you can actually contribute to each account registration. So 401ks, we're going to focus on under the age of 50 to keep it simple. 401ks, based on IRS tax rules for 2025, the most an individual can contribute or defer as an employee to their 401k is $23,500. Okay, there are no phase-out limits as far as you making too much income in order to participate when it comes to your 401k. So I would say it favors everybody, but it definitely favors those who are higher earners because there's no phase-out for participation.
Now, the tax treatment, I think this is an important note. If you're using a Roth 401k versus a Roth IRA, the tax treatment, the tax advantage, and ultimately the strategy of eliminating Uncle Sam as a future partner is effectively the same. Right? If I'm using my Roth 401k, those dollars will be tax-free as long as I meet the qualifiers later, just like the Roth IRA would.
The biggest difference is going to be contribution limits. And so again, if we're just generalizing a 401k in general, $23,500 for anyone over the age or under the age of 50. If we look at a Roth IRA or just an IRA in general, the annual limit for 2025 per the IRS is $7,000. Now, it is subject to income phase outs as far as, if it's going to be considered deductible if it's a pre-tax IRA or if you're even eligible to contribute to a Roth IRA from an income phase out standpoint. And again, we can get into some of that here in a little bit. But on the surface level, if we're going to look at Roth 401k versus Roth IRA, they're essentially the same. One's being provided to you by your employer, the Roth 401k. The Roth 401k has a higher contribution amount in a single year, $23,500 per the IRS for anyone under the age of 50. With the personal Roth IRA, you have more flexibility in what you can invest in. But again, lower contribution limits of $7,000 so far for 2025 per the IRS, and you're going to be subject to income phase-out limits.
Okay. So let's jump into, you've kind of gotten into it, so we'll jump right over. Why would I, as call it a W-2 employee, right? I work for an employer. I have access to a 401k if I do so wish to use it. But I've also heard on LinkedIn, online, on social media that I should also have a Roth IRA. Why would I choose one or the other, right? What's the purpose behind using either one of the options, or what advantages do I gain?
So one of the primary advantages there would be, again, let's work through our orders of operation from a financial fortitude standpoint. One, we always know at the very top, it's becoming an extraordinary wealth builder. So saving 15 to 20% of our annual gross pre-tax income. Well, one of the freebies, as far as where should we allocate percentages of that 20% target, would be employer match. Well, if I'm a W-2 employee and my employer offers a dollar for dollar match up to 5%, 6%, 7%, or 8%, well, then I should consider or be inclined to contribute or participate in putting whatever amount I'm required to put, let's just call it 5%, into my 401k in order to get the dollar for dollar match from my employer.
What's
right?
your
'Cause it's
personal
free
IRA?
money.
Yeah, free money. What your personal IRA is not getting you in that instance.
Right, because your employer is not going to match what you're putting into your personal Roth IRA, right? Or just IRA in general. Now, the question then becomes, well, should I use Roth or pre-tax? And again, today's conversation is primarily just Roth, so let's just focus there. Well, if I'm putting it into the Roth 401k, again, like you just mentioned just a little while ago, you're going to get the exact same tax advantages on those dollars across the course of your retirement accumulation journey that you would if you put those same dollars into your Roth IRA. The big difference to overemphasize is that you're going to get no employer match, right?
Okay.
So in my mind, order of operations is say, hey, let's go ahead and just contribute up to the match, put it into the Roth 401k. We're getting the employer match. That's the incentive. Now, if I want to continue to save additionally above and beyond that, I'm likely going to go ahead and open up a Roth IRA, assuming that I meet the income requirements, that I'm not phased out, and go ahead and try to max that out, right?
Okay.
And so again, the limit there would be $7,000.
So advantage one with the Roth 401k is I'm essentially getting free money, right? Everybody likes that. We're going to try to take advantage of as much free money or free return as we can. Now, you said next is once we hit the match, we might consider a personal Roth IRA after that. What's the advantage in doing that rather than just continuing to use the Roth 401k? I'm already doing it up to match.
Yeah, so the benefit there is that you would be able to have greater flexibility and autonomy over how those dollars are going to be invested. That's one. So a greater universe of investment vehicles or structures or strategies to select. Another one would be that with the Roth IRA, the personal one, you have the flexibility or optionality to withdraw your principal contributions into the account. So as an example, let's say I opened an account, I put $7,000 in, that's the limit. And after the first year, it grows to be $8,000. Okay, after that first year, if I need to pull money out because of an emergency, I actually can pull out $7,000, my principal contribution up to that point, without being subject to any sort of penalty or tax. So there's no early withdrawal penalty of 10%, and I'm not having to pay any taxes on the gains because I didn't pull any of that out. Well, then that second year, I add another $7,000 and it grows some more, right? So the reason why I don't like this approach is because it creates an auditing nightmare for the financial advisor and the CPA or trusted tax professional. However, some advisors are more inclined to take that path and treat the Roth IRA for dual purpose.
So advantage of the 401k is I get free money or the match as long as my employer offers it. Advantage of the personal Roth IRA is I have much more autonomy and flexibility in how that money gets invested to grow, and I have access to that money without nearly as many hoops as I might in the 401k. So more flexibility just in nature.
Correct.
So I think the big challenge that a lot of clients then experience is, Michael, Brady, I am using my Roth 401k up to the match. And I'm now using my Roth IRA and working to fill it to the max. But I'm out. I'm out of eligible dollars. I have put the $7,000 into the Roth IRA as planned, and I have extra that I might be willing to save. What other options do I have at that point, or how does the 401k help me again, if at all?
Yeah, so if you're just a extraordinary wealth builder and you're at a point to where you're saving, that 20%, and you're already contributing up to the match, you're maxing out the Roth IRA at $7,000, and you want to continue to put more towards your long-term bucket, that retirement bucket. Well, now we can go back to the Roth 401k and continue to capitalize on maxing that out up to $23,500. Now, if you are very aggressive with saving, you're a very high income earner, and you want to put more into your Roth, well, once you max out your employee deferral of $23,500 in the 401k plan, you have the optionality to make what's called a non-deductible contribution into the plan, which are essentially additional dollars into your 401k that you could then do what's known as a mega backdoor Roth conversion, right? So basically moving it from the 401k plan into your Roth IRA through the process of a conversion. And we might have to have a completely separate episode on that just to dive into the nitty gritty. But again, I think what I don't want to oversell here in this conversation, what I don't want us to oversell is that, hey, all these dollars that we're saving should be going into Roth buckets, right? Roth buckets are powerful. They're great. They're double tax advantaged. Having tax-free dollars to spend in retirement is very powerful and can go a lot further from a longevity perspective, right? We can mathematically illustrate that for clients. We still need to make sure that we're having balance with, okay, well, if we're saving 20%, let's say we earn $250,000 a year, 20% of our earnings is going to be 50 grand a year. How much of that 50 grand should be isolated to short-term goals, midterm goals, and long-term goals? And again, the purpose of today's conversation is to really focus on the long-term goals. I just don't want it to be misconstrued that, hey, we need to be hyper-focused on putting every single dollar that we save into either a Roth 401k or a Roth IRA.
Okay. So big advantages that I'm hearing with all of that in mind is the 401k's primary benefits, the Roth 401k, is free match if the employer offers it, and then higher contribution limits. If I have the ability to save a lot of money for a long-term bucket, the 401k is going to provide more advantages to me. The individual IRA, the personal one, I have more flexibility and more options, but the disadvantage is the contribution limit is lower. So if I'm a fantastic saver or saving at a high volume, I may quickly exhaust that bucket, and there's only so much flexibility I can build in with $7,000 a year.
Correct. And one thing to note, and this is more of like an added benefit, is that with the 401k option, you do have the option of taking out 401k loans if you need access to capital, right? We talked about how you can pull out your principal contributions from your Roth IRA without penalty. Well, if we're very focused on leveraging the Roth 401k, if you need access to capital and we haven't prudently put it in other buckets, Roth 401k loan is a viable option as well, right? So you're not completely locked out of it, but again, these are longer term buckets. The focus is to be intentional about not leveraging them or accessing them before age 59 and a half if we can otherwise.
Let's discuss next what I would almost call is the high income trap of using an IRA, at least a personal IRA that is the phase out limits. Talk to us about how those work, what they are, and how oftentimes clients have no idea that they may be having a tax problem or an issue of some kind.
So if we refer to the IRS, the 2025 IRS limits from a Roth IRA eligibility standpoint, so let's focus on the personal Roth IRA. If you file your taxes as a single individual, your modified adjusted gross income phase out is going to start at $150,000 all the way up to $165,000. So another way of looking at this is that if you make $152,000, you'll be able to participate some towards your Roth IRA for that year. You might not just be able to contribute the full $7,000. It's going to be reduced some, right? There's a formula that we won't get into because I'll be nerding out too much and you guys will end up changing to a different podcast. Now, if you're married filing jointly, the modified adjusted gross income phase out starts at $236,000 up to $246,000. So again, if you are at or exceed the upper limit of that phase out, you are not eligible to make contributions directly to your Roth IRA. So one thing that we come across when auditing other new clients or existing clients' accounts is that if you're used to making monthly contributions to your Roth IRA, and you're on the cusp of potentially being somewhere in between or past the phase out limit, it might create a huge headache of having to recharacterize or pull money out of your Roth IRA come tax season or before the end of the year so that you're not having to be penalized on those excess contributions, right? Because again, if you're beyond the phase out, the upper limit, you cannot participate with a Roth IRA. So we just want to be mindful of that. If you're a high income earner, it probably makes sense to contribute to your Roth IRA at least once a year, typically around tax filing season, because you do have until April 15th during tax filing season to make a contribution towards your Roth IRA or traditional IRA for the prior year tax season.
So what I'm hearing there is essentially that flexibility that I'm looking for from a Roth and investment choices and access to dollars on a contribution standpoint. If I'm a high earner, if my modified adjusted gross income is typically over $200,000 a year, I don't have access to that bucket.
Correct. As a single filer, yeah, you wouldn't have access to that bucket. So in my mind, it's okay, well, if we have the capacity to save at a minimum $7,000 a year, well, let's take a step back. If you earn $200,000 as a single filer and your employer doesn't offer you any match, well, the question then becomes, well, can I participate in a Roth IRA? Am I eligible? Well, based on your modified adjusted gross income, the answer is no. So even though there's no incentive to contribute to the employer-sponsored 401k, the Roth 401k, if we're trying to build up an army or a surplus of future tax-exempt dollars, we're going to have to contribute to the 401k plan, right? Because it's our only viable option. So contributing the $7,000 there at a minimum. Now, if your employer is offering a match, start with the match. We're still not eligible to contribute to the Roth IRA because of our phase out in income. So now if you're going to do an extra $7,000 and you have the room to do so, go ahead and put it into the Roth 401k on top.
And that's a callback to the contribution limit advantage the 401k offers, right?
Correct.
Both on the amount, the actual number of dollars that can go in that account, and then on the income eligibility, right? The Roth 401k does not require you to qualify income at a certain number to use it.
Correct.
So let's talk through, I think, the last piece of this whole conversation from a strategy perspective. It is the secret backdoor Roth contribution. Because I know we have a lot of listeners saying right now, well, actually, I can make contributions to a Roth. I just have to do it in a roundabout way if my income's over the threshold limit.
Yeah, so backdoor Roth is a fun process, but I think it's over sensationalized, especially by social media influencers, because it's sexy, it's appealing, it seems like a loophole. And of course, everybody wants to be able to take advantage of a loophole because they want to feel a part of the crowd. Now, what I will say is that there are certain instances where it makes sense to leverage a backdoor Roth IRA, and there are other scenarios where it just doesn't make sense. We're overcomplicating things. So let's talk about the scenario where it makes the most sense. Typically, it's going to be an individual that's a high income earner above the phase out limit that's not able to participate in the Roth IRA, and their employer either doesn't offer a 401k plan or they don't offer the option for the Roth 401k, and they still want to have some sort of tax exempt bucket for the future, right? Tax-free dollars for the future. So in that scenario, to keep it very simple, what we would do is we would make a non-deductible contribution to a traditional IRA that doesn't have any existing holdings in it, no existing value for simplicity's sake. Just think of it as a conduit. And then once the money hits, we would, over the course of a couple of days or almost instantaneously, move it from the traditional IRA into a Roth IRA. Now, again, the reason why this works is because, one, when you put it into that traditional IRA, you're treating it as a non-deductible contribution, meaning you're not getting any sort of intra-year tax deduction or benefit from that contribution. You're basically just parking money there for a short period of time to then move over to a completely different account registration known as the Roth IRA, where it gets the benefit of then from that point moving forward, participating in the markets and hopefully growing to be tax exempt for you in the future with your retirement.
So you can start to see how complicated this gets, because the other caveat I'd at least put here is we have to be very careful of what our total balance sheet looks like, because if you hold a traditional IRA balance outside of that separate conduit IRA, it can begin to introduce additional tax complications. So as Michael mentioned, there is a time and a place for a backdoor Roth IRA contribution. It is a strategy that some clients can really leverage, especially those in the right seat. But for clients who have an already complicated balance sheet and are able to use options that exist and are available to them already in that Roth bucket when they're building their tax-free army, there's a time and a place, right? It's not always the first thing that we're jumping to. Here's what we can help with, a backdoor Roth IRA contribution, right?
Yeah. And again, if that's the lead into the conversation, but there are other areas on your balance sheet that require more attention or more focus, right? We always talk about the way that we consult with clients, it being process driven, us having a triage process and getting a financial MRI of where things are at and focusing heavily, at least from a highest priority, focusing on the tumors, right? The things that are most likely to create devastation on your financial journey or your financial balance sheet first, and then circling back to the broken bones on your balance sheet, which are things that, create discomfort and maybe were a higher priority by way of what's trendy right now, but less important and not really going to derail you from your financial success. So in my mind, it's always, hey, one, let's ask the questions. Are we saving the right amount percentage-wise to our overall gross income? Two, based on how much we're saving, are we putting it in all the right places to maximize the opportunity cost, right? Are we taking advantage of all the tax advantages to us as far as tax deductions, after-tax dollars, and tax-exempt growth? And then based on how we're allocating our savings, does that align with our overall goals and objectives? because what we don't want to do is get too hyper-focused on the future and completely neglect the present.
All right, Michael, so I think you've done a fantastic job of not only describing what a Roth IRA versus 401k is, what some of those advantages look like, how to frame a bigger picture conversation about goals and intentions, purpose-driven. But let's go through an example, maybe one of each, and talk through at least how we'd think about where our dollars get deployed and why. So the example I'll give you is I am a single individual. I am a high earner, but not so high that I earn above the Roth IRA thresholds. Let's say I make $145,000 a year. I've done a fantastic job with your help at becoming an extraordinary wealth builder. So I am saving 20% of my income. And you and I have determined that half of my savings is going to go to midterm buckets. I've already got my short-term taken care of. And the other half of my savings is going to go to long-term buckets. And we've discussed we want to build more tax-free dollars in our army, at least for later. So from a very simple or rounded standpoint, I'm saving either $29,000 or $30,000 a year, give or take $14,500 or $15,000 I'm putting towards a Roth bucket of some kind. My question to you is, hey, where should that money be allocated amongst my Roth 401k and Roth IRA, and why? Oh, and I guess one more thing is I do get a company match, and that company match is 5%. I know that's a lot to give you offhand like this, but would love your thoughts or our thoughts on how we'd end up really at least thinking through this.
Yeah, no, of course. Okay, so I think one, from a contextual standpoint, we're making $145,000 gross, which means if we're hitting that extraordinary wealth builder target of 20% of gross income, that means that our annual bogey savings-wise is $29,000. Now, from there, you mentioned employer matches 5% dollar for dollar based on your contribution and participation into the retirement savings plan. So there's an incentive for us to take advantage of that free money, right? Especially if we plan on being at this company throughout the vesting schedule, whatever that might be. So at a minimum, if we take 5% of that 145, that's going to offer a contribution by you of $7,250. Now, from there, because we want to continue to save above and beyond that, and we have additional purse or money set aside because what we're saving is $29,000, well, we're going to then take $7,000 on top of that, $7,250, and put it into your personal Roth IRA. Okay, so you've basically dedicated $14,250 towards Roth dollars, right? A portion of that in your Roth 401k in order to be able to get a match of $7,250. You put $7,250 in, employer's matching dollar for dollar, and then putting an additional $7,000 in your personal Roth IRA. That leaves us with $14,750 to be allocated toward your midterm bucket, that opportunity fund, something that's going to be invested in the market with after-tax dollars, and then getting into long-term and short-term capital gains whenever we need to utilize that, or setting up securities-backed line of credit for flexibility and optionality with how we use that money. But all of this because you've already done an excellent job in being proactive and purpose-driven with establishing your 3 to 6 months worth of living expenses in your emergency fund.
So as an example, I've got the $14,750 going to my midterm bucket. We'll call that a brokerage account. I've got the other $14,000 and change funding up to match for the 401k, effectively fully funding the Roth IRA. What if I come back to you towards the end of the year and say, you know what? I don't need as much money in my midterm bucket. I've got an extra $5,000 or $10,000 that I really want to dedicate to long term, right? My parents helped me out with that down payment, or my girlfriend or spouse helped me out with that down payment. I didn't need as much as I was expecting. Where do I deploy, say, an extra $5,000 or $10,000 if I'm still trying to build that tax-free army? I have more money available for the long-term bucket.
Yeah, if you're trying to continue to grow that tax-free army, well, you have wiggle room with additional contributions into your Roth 401k plan throughout the course of the year. So not to get too technical, but depending on if you're going to be able to have it withheld from your payroll or be able to make additional contributions into the 401k plan, you would have to just check with your plan sponsor and the plan document. But you basically have a runway of an additional $16,250 based on you contributing the $7,250. Because one thing we haven't explicitly stated is that your employer match doesn't actually count against the $23,500 that you get to contribute as a participant. Their match is above and beyond the $23,500 that you get to participate or contribute as someone under the age of 50.
Okay.
So if you had an extra $5,000 to $10,000, you have enough wiggle room to allocate that towards your Roth 401k and still giving you some excess room to put more if more money shows up.
Okay. So the waterfall was employer match with the Roth 401k into personal Roth IRA bucket for flexibility, back into Roth 401k once that bucket was full.
Correct.
Okay, Michael, so I'll throw one more scenario at you, a little more complex. But let's say I'm a recently graduated resident. I'm now an attending physician and my income has taken a notable step up. So I went from making $75,000, $85,000 where the saving was easy, right? Maybe not in the same volume, but it was simplified. Now I'm making $350,000. I'm still a single filer and my situation is effectively the same. My employer offers a 5% match. You and I have discussed being an extraordinary wealth builder at 20% of income. And I've got half of my dollars I want to deploy for midterm goals, half of my dollars I want to deploy for long-term goals. But I still want to use the Roth bucket. It's important for me to build those tax-free soldiers. Where do we start or where do we go from here?
Yeah, so if we think about order of operations again, right? In this scenario, it is a little bit more complex in having to understand the rules and what's eligible and what's not. But the waterfall, in essence, is relatively the same. Commas might just be in different areas, right? So let's just start with the top and work our way down. So $350,000 gross. I'm an extraordinary wealth builder saving 20%, which means I'm saving $70,000 a year. That's the bogey. Well, 50% of that's going to go long term. Well, that means about $35,000 is going to be dedicated towards quote unquote retirement focus. Well, what do I know? Well, I know that my employer offers a match, 5% dollar for dollar. So if I contribute 5%, that means I'm putting $17,500 towards my Roth 401k. Well, the maximum limit that I have as somebody under the age of 50 is $23,500 for the 2025 tax year. So that gives me a little bit more wiggle room to contribute a little bit more above and beyond, right? Roughly $6,000 more, right? To get to $23,500.
I'll interrupt you here because I've captured the employer match like I had in the past. And now wouldn't it make more sense or most sense to go gather some of that flexibility that the personal Roth IRA offers, that $7,000?
Yeah, absolutely. Because we already know that being at $350,000, we're above the phase out limit as a single filer to be able to contribute directly to a Roth IRA, right? And again, under the age of 50, that contribution is $7,000 into
so
the
I can't use that
individual Roth
bucket
IRA. So
then.
I can't use that bucket per se unless we want to look at backdoor Roth. Now, with that being said, if I want to do a backdoor Roth, I don't have any personal traditional IRAs that I've rolled out, right? So I don't have to worry about double taxation if I put money into a conduit and try to convert it over to a Roth. Hopefully we didn't lose anybody with that statement. But the maximum that I can do from a backdoor Roth would be $7,000. So this is where we could start to leverage what would be considered a quote unquote mega backdoor Roth in essence per se. So what we're going to do to recap is we're going to take 50% of our annual target of $70,000, which is $35,000. The max I can put into a Roth 401k as an employee deferral is $23,500. Okay. Well, I still have some wiggle room of $11,500 that was earmarked or intentionally focused towards Roth dollars or retirement dollars. Well, if I decide to do a backdoor Roth of $7,000, I'm still leaving money on the table. So we might as well go ahead and elevate up to the $11,500, make a non-deductible contribution to the Roth 401k, and then do a mega backdoor Roth into my personal Roth IRA from the employer-sponsored plan, assuming the plan document allows it. So in summary, we were able to put all $35,000 towards the Roth bucket. We just had to be a little bit more strategic, and there were a couple more moving parts.
So I think I got a little lost there, but might be on the right track. So my original contribution to the 401k at the 5% was, call it $17,500. I can't make a regular Roth contribution because my income's too high. So what normally would have gone into the regular Roth contribution, we just went and put in to fill our Roth 401k up to the $23,500.
Correct, but you don't get to do the full $7,000 because you already put $17,500 plus $7,000 puts you at $24,500, which is an excess contribution.
Yes. So now at that stage, all of the remaining dollars we could consider doing a backdoor Roth and or a mega backdoor Roth if we're eligible. Now, more complicated, and obviously that's something you need to talk with your tax professional on, CPA, and more complicated from a planning standpoint. But I think the major takeaway was, let's keep things simple, at least in accomplishing the goals that we are first. If the goal is to put as much money in a Roth bucket as possible, the 401k gives us the biggest size of bucket to use. We don't need to go down the backdoor Roth path until we know we've fully exhausted the 401k. And then only do we look and say, what strategic either loopholes or planning changes can we make to try to get more money into one of these buckets?
Correct. And then the other $35,000 that's sitting on the sideline that's earmarked for midterm goals and opportunities would go into the other investment account that we've discussed in multiple episodes, as well as in the other scenario. So in either scenario, we shouldn't think about overcomplicating our actions. We should just keep it as simple as possible and just make sure we understand what's available to us in maximizing what is and then waterfalling into other opportunities. But again, this is why surrounding yourself with trusted professionals such as CPAs, tax professionals, and a financial advisor can be helpful, because you don't have to stress about it. You can refer to them and they should be able to guide you along the way.
So in summary, what I'd say is that Roth IRAs and Roth 401ks both give you something incredibly valuable from a long-term perspective, and that's tax-free growth in income when it comes time to retire. But knowing when and how to use each one can make the difference between a good strategy and a great one. So if you're not sure where your money should be going, let's talk.
If you enjoyed today's episode, be sure to subscribe, share it with a friend, and leave us a review. That helps more people find financial fortitude and start making smarter financial moves.
Thank you for joining us this week on the Financial Fortitude podcast. We hope you enjoyed the show and learned something along the way.
If you're looking for financial guidance that is personalized to your specific needs, we're here to help. Visit us at www.genesiswealthplanning.com to book a complimentary consultation.
That's it for today. Make sure you subscribe so you don't miss out on future episodes. And as always, please share with others you feel could benefit from the show. See you next time.
This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Genesis Wealth Planning LLC, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. All scenarios and names mentioned herein are purely fictional and have been created solely for educational purposes. Any resemblance to existing situations, persons, or fictional characters is coincidental. The information presented should not be used as the basis for any specific investment advice. Acosta and Brady Hemmerle are registered representatives and financial advisors of Park Avenue Securities, LLC, PAS. Securities, products, and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representatives of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Consolidated Planning Group, Inc. and Genesis Wealth Planning, LLC are not affiliates or subsidiaries of Park Avenue Securities or Guardian. Michael Acosta's California Insurance License Number 0M50974 and Brady Hemmerle's California Insurance License Number 4353077 7237198.20, expiration 1027.